morning. Hello from a rainy, foggy Tokyo, Japan. I'd like to welcome you today to Open Banking Week and to share with you a perspective on open banking beyond the API. It's really not about this. It's very easy to get distracted by technology. The future is ours to create. And technology is just an enabler of that future. It's not the goal in its own right. What really matters, of course, is people and value. Not to digitize the past, not to take legacy models and digitize them and deliver them as if they're something new. Digital is just a tool set. And so the way that we think about transformation has to completely change. Because the real opportunity is to transform capital, to look between the silos in an organization and between the balance sheets of companies across supply chains, to really focus on capturing that value that leaks between those expertise. When we look at what we need to focus on, we need to focus on how we optimize the key disciplines of capital, risk, and time. Because we all know that time is money. We also know time is risk. Time and risk are the very foundations of our financial system. Obviously, if we reduce time, we increase the return on capital. It's a direct correlation. And what technology is fantastic at, and indeed its only purpose, technology arbitrages time. And if you have a time advantage, you have a competitive advantage. And if you have a competitive advantage, it means that you arrive at the finish line before your competitor, which means you live in their future. You can out-execute them. And that's the real magic of technology. It empowers us and gives us the tool sets to execute faster than anyone else. We just have to define the race. So our focus is pretty simple. We look at how we can create value for customers in the moment. How do you reduce the amount of time to increase the returns and the value? It's a very straightforward algorithm. Our objective is always to deliver customers true digital experiences. Simplicity outside, move the intelligence inside, and embed everywhere to scale. These are the core drivers of every digital experience. And indeed, they're the core drivers of what we want to create with open banking. To really achieve our potential, we need to understand the time value of money. We need to understand that if we were to earn a year, and to make the mathematics simple, and we earned our pay, or $100 pay, and we didn't get paid until the end of the year. That means over that year, we're going to accrue a cost of debt, be it a mortgage, a credit card, or etc. But let's just make it simple. At a 20% interest rate, you're going to consume $20, which means that your net income would be $80. If you accelerate that forward and can get $100 today, that's where the magic happens, because you've changed your basic assumption around time. And you're able to reinvest that at a rate which delivers you an investment return where the minimum investment return is to pay down other debt. This gives you the ability to earn $120 versus $80 in this example. But the same correlation holds true. The time value of money is critical in understanding how we use financial services to create value for customers. It gives us the opportunity to truly transform lives. Open banking is about driving inclusion, but we can make it so much more than that. How we drive value is looking at different business models. If you look at savings, typically it's below inflation rate. So if we digitize a below inflation rate product, all you've done is just change the mechanism of delivery. There's very little value. If you look at the return of the S&P 500 since 1872 to 2018, it's averaged a return net of inflation of 6% per annum, 6.8% versus negative to inflation for savings. Savings keep the poor poor. How can we design new business models that actually start helping customers create value and money in a responsible way, of course. These are the sorts of challenges we need to really look closely at with open banking. In another area, if you look at employee value, and going back to the payroll example, you're seeing people digitizing payroll advances. And some of those rates, by replacing simply a fee, there's a fixed charge versus an APR, they're actually coming out as high as 178% for that acceleration of capital. That is not the objective of what we want to achieve in open banking and inclusion. We want to help our customers deliver more value, not take more value from them. If we're able to do things like we're seeing with innovative companies in other markets, where they're able to take payroll products and be able to provide customers 0% APR and 0 fee to truly create value in the way that we described in our time value of money example. This is the opportunity that we have in restructuring finance in the way that it works, to start looking at the flow of capital and the balance sheet transactions, and to really understand how we can move between silos, not just consumer banking, but corporate banking, even all the way up to equities. How do we combine all of these things together in a way that truly creates value for customers? If we have a look at SMEs, the same thing. How can we change the interest rate from a very high interest rate down to a very low interest rate? There's a company called High 55 in the UK that's really starting to look at this complete transformation of shifting risk from where it's traditionally been shifted down to SMEs and placed and then increased by bankers who increase the amount of capital that's tied up in the supply chain, to looking at how we minimize the amount of capital and maximize the returns off that capital over time. So time is a powerful lever. The challenge in fintech and the challenge with open banking is to challenge ourselves. We've got to challenge ourselves to drive better customer outcomes. And that's where we'll have magic coming out through open banking. To do this, we need to really understand the mathematics of technology, capital, risk, and time. It makes no sense to replicate the models that we have in place. They were built for a non-connected world. They were actually founded 5,500 years ago in ancient Babylonia, where the first lunar cycle dictated the payment term, which is something that we'd kept until we started to inflate those models with capital today. So first principles learning always requires us to understand the past, to understand the reasons that things were done the way they were done. Let's not repeat the mistakes of the past in open banking today. So let me help you to understand technology economics. I used to develop pricing models for technology companies. In 1975, the first digital camera was invented. It was a 0.01 megapixel camera, and it retailed at an estimated price of $28,500, which is a ridiculous amount of money. However, over the next 45 years, that megapixel range has moved from 0.01 to 108 megapixels in this Samsung Ultra, which is now invisible. There is a phone here, but this Samsung phone, this Ultra phone, has a 108 megapixel sensor, and that's likely to increase in next year's phone. But that represents a feature appreciation of 23% per annum over 45 years. So that means that customer expectations of technology increase every year. So unless you're moving your value proposition every year, you're not keeping up with the potential of technology. The flip side of that equation is that the depreciation side. So if you have a look, 1 kilobyte of memory was in the Altair 8800. The cost of that memory was the equivalent in those terms in that day of $11,378 per meg. Fast forward to 2020, a 4 terabyte micro SD card retailed for $748. Now, if we look at that, that's a 33% depreciation rate per annum across the technology spectrum. So that depreciation rate fuels this great delta. And so technology is like sushi. We have to consume it fast or it's wasted. So the annual difference between the value expectation and the depreciation in technology is about 60% per annum. So if you look at last year's phone, you'll see it for about 60% off. It's a great rule of thumb to work out how quickly technology ages. And what most people don't realize is that agile is simply a reflection of technology economics. It says that if you can't get it delivered in 3 months, it's essentially waste. And the reason for that is that the value expectation for the customer is likely to have changed. And the flip side of that is that the depreciation of what you've put in place is going at a total delta between the two of 56% per annum, circa 60%. So all we know and all we have learned from technology is that customer expectations change. And every year they expect better, cheaper, faster. They're expecting more value every year. And that's our challenge in the world of fintech. Digital economics builds upon what we have in technology economics. Technology economics is actually driven by the 3 core laws of technology: Moore's law, Metcalfe's law, and Kreider's law. Law of processing, law of networks, law of storage. If you'd like to think of where AI sits in the middle of those 3 laws. It's the ability to process or to assimilate learning, which is networks and IoT, into data, which is knowledge. AI sits as your primary engine that's growing faster than each of those 3 laws on an exponential basis because it sits at the confluence of 3 laws. So digital economics takes that fundamental basis and extends it. When we build a new platform, we have a fixed asset. And our challenge, and every entrepreneur's challenge, or every institution's challenge, is when they build that platform is how quickly they can scale it. So they broaden distribution. Once they've broadened distribution, then the challenge becomes, how do I increase the product portfolio that I put over that distribution? So I create a connected portfolio. If you look at this, this is exactly the way that Tencent built WeChat. At first, it was QQ, a dedicated platform, which was messaging in much the same way as Microsoft Messenger. That's all it did, a one-trick pony. And it built massive distribution, 750 million people. But then the ability to just add products on top became too complicated. It hadn't found ways to create efficiency and connection between those product lines or that portfolio. So now when you create connected portfolio product, if you're successful at that and you've removed the friction from moving between one product and another, then you can end up in the magic quadrant of scale, where you're scaling both the product value and the distribution value. Scale drives digital economics because it amortizes the fixed asset cost. If you have $1,000 right in fixed asset and you have 1 customer, marginal cost per customer is 1,000. If you have 1,000 customers, the marginal cost is $1. If you have hundreds of millions of customers, now you're down to fractions of cents. That's the value of digital. So if we think about that, our objective is to minimize fixed asset costs through reuse, then to maximize embedded distribution. How do we go into as many networks as possible and really expand the speed at which we get out to market? Then we scale connected, simplified and connected portfolio of products. And if we're successful at that, we're in the winner's zone, where we're creating the maximum value for customers and the maximum value for ourselves. And that's the object of the ultimate objective of all digital business models, scaled profitable growth. So when we look at companies, it's very easy to see if we understand technology economics and then we understand digital economics, we can see when companies are accelerating and decelerating. So it's very easy to see when you're adding products that have diminishing value or returns or have perhaps created too much friction in adoption. The impact is profound. We're seeing traditional financial services rapidly declining in value. If you're working out where to invest, do you invest in an old bank or do you start looking at big tech? And big tech's, of course, growing and continues to grow at massive scale at an incredible rate. And then if you have a look at fintech, which is pure play digital, because we don't move physical items, you're actually seeing return rates that are significantly higher. This transforms not only from the digital world, but it actually impacts traditional financial institutions in the same way once they understand these principles. So this was a bank that I had actually was their founding chief innovation officer for, and they became known as the best digital bank in the world, best SME bank, and indeed best bank in the world, I think last year. And what you saw when they opened up their digital banking channel is that from a digital bank customer acquisition standpoint, acquisition went through the roof. Now, of course, scale, return over fixed asset, and the ability to create, getting it right the first time enables you to start driving down customer acquisition cost. And there's still the potential, of course, to go much further on that. But the net impact on the banking side was basically 2x net income. This will be amplified with open banking. The idea of now expanding those networks and competing in ways in a very light cost, where you're taking those core connected services and making it incredibly easy for customers to come to you down through open banking and into your greater funnel of business. There are 3 core metrics which are imperative to any digital business model. And for me, they're all time related. Time to value, time to quality, and time to scale. Time to value is not just value for yourself, it's value for the customer is the first point. If you can't create value for the customer, don't even try to create value for yourself. Don't try to understand marginal cost and digital economics. If there's no value for the customer, you haven't hit even the first point of digital. Start with time to value for the customer, then engineer out the digital economic side to work out how you can continue to grow value on your side of the equation. Time to quality is incredibly important. If you take something out without quality, your NPS halves. So if you want to drive customer acquisition costs down, according to Bain, but according to common sense as well, your NPS doubles if you get it right the first time. So a focus on quality is incredibly important. And then, of course, the final metric, which investors always love, is how quickly can you scale? But there's no point scaling a poor quality product. There's no point scaling a product with poor value. Our challenge is to really understand financial mathematics and to work out how we can optimize all of these 3 core metrics. We need to understand that our relationship with technology is changing, and it's changing rapidly. And we need to think very differently about how we use technology. We need to follow the principles of digital economics, technology economics, and indeed truly understand what the 3 laws of technology means. Moore's law, Metcalfe's law, Kreider's law. If we want to transform our world, if we want to drive inclusion, if we want to increase value to customers, and we want to increase the value of our companies, we need to think very differently. And of course, the most important thing in all of that is that time matters. Time matters to customers, time matters to corporations, time matters to fintechs, time matters to investors. Time is the most valuable resource we have. It's the foundation of our financial system. And anything that we can do, if you only remember one thing from this presentation, time matters. Thank you. And as I always say, create the future, don't be retired by it. Thank you.